You know what's fascinating about human psychology? We create these invisible lines in the sand, these arbitrary numbers that somehow hold more power over our decisions than actual fundamentals. And right now, we're watching one of the most significant psychological barriers in precious metals history get absolutely shattered. Gold just crossed a threshold that's been talked about in trading rooms and central bank meetings for years. And what's happening next? It's not just about the price anymore. It's about what happens when millions of investors suddenly realize they've been sitting on the sidelines while the biggest wealth transfer of our generation unfolds right in front of them. Let me paint you a picture of what's actually happening behind the scenes, because the mainstream financial media is completely missing the story. They're focused on the number. Sure, that's important. But they're not telling you about the panic buying that's already started in Asia, the emergency meetings happening at major banks, or why some of the smartest money managers on the planet are now scrambling to increase their positions. Here's what you need to understand. Psychological barriers in markets aren't just about round numbers looking pretty on a chart. They represent years of collective belief, resistance levels that have been tested and held. And most importantly, they represent the moment when the crowd psychology shifts from skepticism to belief, from caution to urgency, from maybe someday to I need to act now. Think back to Bitcoin in 2020. Remember when it crossed $20,000 again after years of being below that level? What happened next wasn't just a modest increase. It went parabolic to $60,000 in a matter of months. Why? Because crossing that psychological barrier triggered a cascade of FOMO, fear of missing out, that became self-reinforcing. Every headline about new highs brought in more buyers. Every conversation at dinner parties created more urgency. Every financial advisor who had been cautious suddenly had clients demanding exposure. We're seeing the exact same setup in gold right now, but with one critical difference. The fundamental drivers behind gold are far more powerful than anything we saw with Bitcoin. We're not talking about speculation on future utility. We're talking about central banks buying at record levels, currency debasement accelerating globally, geopolitical tensions reaching breaking points, and a global monetary system that's showing cracks in its foundation. Let me take you inside what's really happening. Over the past 18 months, central banks have been accumulating gold at a pace we haven't seen since the 1950s. The People's Bank of China has been adding to reserves month after month. The Reserve Bank of India just announced another major purchase. Poland, Singapore, Turkey, countries that historically held modest gold reserves, are now buying aggressively. Why? Because they see what's coming. They understand that the dollar's dominance as the global reserve currency is being challenged in ways that seemed impossible just 5 years ago. The BRICS nations aren't just talking about alternatives anymore. They're building infrastructure for trade settlement outside the dollar system. Saudi Arabia is now accepting yuan for oil sales. The United Arab Emirates is stockpiling gold in preparation for a new monetary framework. These aren't conspiracy theories or fringe predictions. These are documented policy shifts happening at the highest levels of global finance. And when central banks move, they move with information and analysis that retail investors don't see until months or years later. But here's where it gets really interesting. The physical gold market is showing signs of stress that veteran traders are calling unprecedented. The premium for physical gold over paper gold contracts has been widening. Delivery delays at major refineries have been extending. Some dealers are reporting allocation limits on popular products. What does this tell us? It tells us that the paper gold market, the futures contracts and ETFs that most people think of as gold, might not be as well backed by physical metal as everyone assumes. There's a concept in markets called price discovery, and we might be entering a phase where the real price of physical gold starts to decouple from the paper price. Imagine what happens when investors who thought they owned gold through ETFs or certificates suddenly realize they own a claim on gold that might not actually exist in a vault somewhere. The rush to convert paper claims into physical metal could create a supply shock that makes current prices look quaint. Now, let's talk about the technical picture, because the charts are telling a story that's remarkably clear. Gold has been building a massive base pattern over the past few years. Every pullback has been met with aggressive buying. Every breakout has been followed by consolidation at higher levels. The 50-day moving average has been trending above the 200-day moving average, what technicians call a golden cross, for months now. Volume has been increasing on up days and decreasing on down days, which is exactly what you want to see in a healthy uptrend. But more importantly, we're seeing something called accumulation in the price action. This is when large institutional players are quietly building positions without pushing the price up too aggressively. They're patient, they're strategic, and they're positioning for something much bigger than a short-term trade. The resistance level that just broke? It had been tested multiple times over the past year. Each time gold approached it, sellers would emerge and push the price back down. But each subsequent test saw less selling pressure. The sellers were getting exhausted. The buyers were getting more aggressive. And finally, the barrier broke. Not with a tentative probe, but with conviction and volume that suggests this isn't a false breakout. What happens next is where human psychology takes over. Investors who have been watching from the sidelines. Maybe they bought some gold years ago and sold it during a correction. Maybe they've been meaning to add exposure but kept waiting for a pullback. These investors are now facing a dilemma. Do they wait for a dip that might never come? Or do they accept that the train is leaving the station and they need to get on board? History shows us that once psychological barriers break, the FOMO phase can be intense and sustained. Look at what happened in 2011 when gold crossed $1,500. It didn't stop there. It ran to $1,900 in a matter of months. Look at what happened in 2020 when gold broke through $1,800 after years of consolidation. It surged to $2,070 in weeks. The pattern is consistent: breakthrough, consolidation, acceleration. But we need to talk about the elephant in the room, the reason why this particular barrier breaking is more significant than previous ones. The global debt situation has reached levels that would have been considered impossible just a generation ago. The United States is adding $1 trillion to its national debt every 100 days. Japan's debt-to-GDP ratio is approaching 260%. European nations are running deficits that violate their own fiscal rules. And the solution being proposed? More spending, more debt, more monetary expansion. When governments are trapped in a debt spiral, there are only 3 ways out: grow your way out, inflate your way out, or default. Growing your way out requires productivity gains and economic expansion that we're not seeing. Defaulting is politically unacceptable. That leaves inflation, the slow, steady debasement of currency that transfers wealth from savers to debtors, from the prudent to the reckless. And what's the traditional hedge against currency debasement? What asset has preserved purchasing power through every major inflationary episode in human history? Gold. Not because it's magical, but because it's finite. It can't be printed, and it's been recognized as a store of value for thousands of years across every culture and civilization. Quick aside here. If you're sitting on $100,000 or more in retirement accounts and you're concerned about currency debasement and inflation, I put together a comprehensive guide on how gold IRAs work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties, what the rules are, and what to watch out for. Worth checking out if that's relevant to your situation. Now, back to what's happening in the markets right now. The COMEX, the major exchange where gold futures are traded, has been showing some unusual patterns. Open interest has been climbing while the price has been rising, which typically indicates new money coming into the market rather than just short covering. The Commitment of Traders report shows that commercial hedgers, the big banks and institutions, have been reducing their short positions. This is significant because these players usually have the best information and the deepest pockets. Meanwhile, the gold mining stocks are starting to wake up. For years, mining stocks have underperformed the metal itself, which is unusual historically. Typically, mining stocks act as leveraged plays on gold. When gold goes up 10%, mining stocks might go up 20% or 30%. But that leverage has been broken for a while due to concerns about operational costs, political risk, and capital allocation. Now, we're seeing some of the major miners starting to outperform, which suggests that investors are gaining confidence that higher gold prices are sustainable. Let's talk about the supply side for a moment, because this is where things get really interesting. Gold production has been essentially flat for the past decade. The easy-to-mine deposits have been exhausted. New discoveries are rare and typically in politically unstable regions. The lead time from discovery to production is measured in decades, not years, and the all-in sustaining costs for many miners are now above $1,200 per ounce, which means there's a floor under the price that's much higher than most people realize. On the demand side, we're seeing strength across every category. Jewelry demand in India and China remains robust despite higher prices. Industrial demand for gold in electronics and technology continues to grow. Central bank buying is at multi-decade highs. And investment demand, the category that includes bars, coins, and ETFs, is starting to accelerate as more investors recognize the changing monetary landscape. But here's what keeps me up at night, and what should concern anyone paying attention to global finance. The derivatives market for gold is enormous, complex, and potentially fragile. There are estimates that suggest the notional value of gold derivatives is many multiples of the actual physical gold that exists above ground. These derivatives include futures contracts, options, swaps, and various structured products that banks use for hedging and speculation. What happens if there's a crisis of confidence in these paper claims? What happens if a major counterparty fails to deliver physical gold when contracts come due? What happens if investors start demanding physical settlement instead of cash settlement? The potential for a squeeze in the physical market is real, and it's something that sophisticated investors are quietly preparing for. Think about the mechanics of a short squeeze for a moment. In most markets, when prices rise, short sellers can eventually cover their positions by buying back what they sold. But in the physical gold market, if there's not enough metal available for delivery, short sellers can't just manufacture gold out of thin air. They're forced to either pay whatever price is necessary to obtain physical metal, or they default on their obligations. Either scenario would be catastrophic for the paper gold market and would likely send physical gold prices to levels that seem unimaginable today. Now, I want to address something that I hear constantly from skeptics. Gold doesn't pay dividends or interest, so why would I own it? This argument fundamentally misunderstands what gold is and what role it plays in a portfolio. Gold isn't an investment in the traditional sense. It's insurance. It's a hedge against the debasement of fiat currency. It's a store of value that exists outside the banking system and government control. When you own gold, you're not trying to generate income. You're trying to preserve purchasing power. You're trying to protect against the risk that the dollars, euros, or yen in your bank account will buy less in the future than they do today. And given the monetary policies we've seen over the past 15 years, zero interest rates, quantitative easing, direct monetary financing of government deficits, that risk is very real. Let me give you a concrete example. In 1971, when President Nixon closed the gold window and ended the dollar's convertibility to gold, an ounce of gold was worth $35. A new car cost about $3,500, roughly 100 ounces of gold. Today, gold is trading well above $2,600 per ounce. A new car costs about $48,000, still roughly 100 ounces of gold. The purchasing power of gold has remained relatively stable over 50 years, while the dollar has lost more than 85% of its purchasing power. That's what gold does. It doesn't make you rich. It keeps you from getting poor. It doesn't generate returns. It preserves wealth. And in an era where central banks are explicitly targeting inflation, where government debt is spiraling out of control, and where the global monetary system is being restructured, that preservation of wealth is becoming increasingly valuable. But here's where the opportunity comes in. We're not just talking about preservation anymore. We're talking about a potential revaluation of gold relative to fiat currencies. If central banks continue to accumulate gold as a reserve asset, if the BRICS nations succeed in creating an alternative to the dollar system, if confidence in paper currencies continues to erode, gold could be revalued significantly higher to reflect its role in the new monetary order. Some analysts are talking about gold reaching $3,000, $5,000, or even higher in the coming years. Are these predictions guaranteed? Of course not. Markets are unpredictable, and there are always risks. But the fundamental drivers are in place for a sustained bull market in gold that could last for years. The geopolitical situation is another factor that can't be ignored. We're living through a period of great power competition that hasn't been seen since the Cold War. The United States and China are engaged in a strategic rivalry that encompasses trade, technology, military power, and monetary influence. Russia, has been effectively cut off from the Western financial system and is now settling trade in alternative currencies. The Middle East is realigning in ways that challenge decades of established relationships. In this environment, gold becomes more than just a financial asset. It becomes a strategic asset. It's neutral. It's not subject to sanctions. It can't be frozen in a bank account or seized by a foreign government. It's the ultimate form of monetary sovereignty, and nations are recognizing this reality. The retail investor is just starting to wake up to what's happening. For years, gold has been dismissed by mainstream financial advisors as a relic, as something your grandfather might have owned, but that has no place in a modern portfolio. That narrative is changing. More advisors are recommending gold allocations. More investors are asking about gold exposure. More financial media is covering gold's rise with a tone of respect rather than dismissal. And this is where the FOMO really kicks in. When your neighbor mentions at a barbecue that they've been buying gold and it's up significantly, when your coworker talks about their gold IRA, when you see headlines about gold hitting new highs week after week, the psychological pressure to participate becomes intense. Nobody wants to be the person who missed the opportunity. Nobody wants to watch from the sidelines while others profit. But here's the critical point. This isn't about chasing a hot trade or trying to time the market perfectly. This is about recognizing a fundamental shift in the global monetary system and positioning accordingly. This is about understanding that the rules of the game are changing, and the assets that thrived in the old system might not be the ones that thrive in the new system. The dollar has been the world's reserve currency for 80 years. That's an incredibly long run by historical standards. The British pound held that role for about a century before the dollar. The Dutch guilder before that. The Spanish real before that. Reserve currencies come and go, and when they transition, the wealth effects are enormous. Those who see the transition coming and position accordingly can preserve and even grow their wealth. Those who cling to the old order often see their purchasing power evaporate. I'm not saying the dollar is going to collapse tomorrow or that the United States is going to lose its economic dominance overnight. These transitions take time, years, even decades, but they follow a pattern, and we're seeing that pattern play out in real time. The excessive debt, the monetary expansion, the loss of manufacturing base, the military overextension, the rise of competing powers, these are all hallmarks of a reserve currency in decline. And as that decline continues, gold's role becomes more important. It becomes the bridge between the old monetary system and the new one. It becomes the asset that maintains value while paper currencies are being restructured. It becomes the safe haven that investors flee to when uncertainty reigns. The technical breakout we're seeing now is just the beginning. The psychological barrier that's been crossed is going to bring in a wave of new buyers who have been waiting for confirmation. And as those buyers enter the market, they're going to push prices higher, which will attract more buyers, which will push prices higher still. This is how bull markets work. They feed on themselves until they reach a point of exhaustion. But we're nowhere near exhaustion yet. The general public isn't talking about gold at cocktail parties. Your Uber driver isn't giving you tips on gold mining stocks. CNBC isn't running 24/7 coverage of gold's rise. These are the signs of a market top, and we're not seeing them. What we're seeing is the early stages of a major move, where the smart money is positioning and the crowd is just starting to notice. The opportunity is still there, but the window is narrowing. Every day that passes, every new high that's reached, every headline that's written, it all adds to the momentum and makes the eventual move more powerful. The investors who act now, who recognize what's happening and position accordingly, are going to look back in a few years and realize they caught one of the most significant wealth preservation opportunities of their lifetime. The question isn't whether gold is going higher. The fundamentals, the technicals, and the psychology all point in the same direction. The question is whether you're going to participate in this move or watch it happen from the sidelines. The question is whether you're going to let FOMO drive your decision-making, causing you to buy at much higher levels later, or whether you're going to act strategically now while there's still time. This isn't about getting rich quick. This isn't about speculation or gambling. This is about recognizing a fundamental shift in the global financial system and protecting your wealth accordingly. This is about understanding that the rules that governed investing for the past 40 years might not be the rules that govern investing for the next 40 years. This is about being on the right side of history when the monetary system undergoes its next major transformation. The psychological barrier has been crossed. The FOMO is starting. The question is, what are you going to do about it?